You were once a fan of smart beta, but something ruined it for you. What happened? Why have you turned against it? Is it just because there's too many of them?
It could be. I mean, one thing is that it could be that there was nothing to start with. I mean, keep in mind that there are literally hundreds, if not thousands, of factors that can be data mined. So if you just focus on, let's say, the 5% of top performing factors, you'll find some of them that will perform well, even though there's nothing there, just out of sheer statistical luck. Money could be another issue, as you point out. We have about 800 billion in assets in smart beta ETFs from close to zero 10 years ago. And every time you see $1 trillion go into a certain strategy or certain type of strategies, things end in tears. I think one thing that investors need to look at when they evaluate these strategies is valuations. Robert? Yeah, sorry, go ahead.
No. I think that's a really good point. Before we get to valuations, Sarah, Vince, obviously not the only one who's a little bit suspicious and skeptical here. Rob Arnott, who is one of the founders of Smart Beta and Factor Investing, is also a little bit skeptical too. He mentioned some big numbers here. Give us a sense of how quickly Smart Beta has grown and if that's where all the growth is, especially in the equity ETFs.
Right, exactly. Vince is definitely not the only skeptic. You will always have your skeptic. And Rob Arnott, who's curiously one of the founders of Smart Beta, he echoes a similar thing to what Vince was just saying, that valuation issue. He put out a paper about 2 years ago that really caused a ruckus, basically saying that part of the reason that these strategies are really succeeding is just because they're increasing in popularity, and as more cash goes in, that inflates their valuations, and ultimately one day they'll crash. And we have seen that pick up in popularity, although there is still more room to grow. Right now, assets under the whole U.S. Smart Beta umbrella are nearing that 800 billion mark. That's nearly tripled from 2012. BlackRock actually estimates that will reach 1.4 trillion by 2022. So we're still seeing some pickup there, and it's mostly right now in equities, but the next frontier, as the issuers say, really is that fixed income smart beta space.
Yeah, so that breakneck pace is certainly concerning. Vince, as we mentioned, you went out to build your own dumb portfolio. What you did was to include companies that were excluded from smart beta funds in general, and you compared their performance to an index made up of 5 smart beta funds that are equally weighted. Dan Draper of Invesco PowerShares said that the ETFs in your test were kind of a hodgepodge. I want you to listen to what he had to say.
I think being able to look at the S&P, more of a pure style exposure, which we offer at Invesco, and we did the same analysis. We had 23 years of data. We ran it. We found that this hodgepodge of equal weighted only outperformed 8 out of 23 years, but using our S&P, more pure factor exposure, outperformed 16 out of 23 years.
Vince, how do you respond to Dan's evidence that their pure factor exposure outperformed?
I mean, it could be at any point in time, you will have some factors that outperform. I mean, keep in mind, if you slice the market in 50 ways, about 25 of these ways will outperform the market. So it could be that his specific ETFs have done better. Now, I can respond for me is I only took the most well-known academic anomalies, and I used the largest font for each one of these categories, focusing on the S&P 500 index, and that's how I ended up with my list of 5 quote-unquote smart beta ETFs. Now, of course, at any moment, some smart beta ETF will outperform. I mean, one thing that we've seen for the past 2 years is the very strong performance of momentum ETFs, partly because the FANG have done so well.
Right.
But again, how likely is it that you would know in advance which factor is going to perform well? If you would know that, you would just buy the FANG. So I think my approach of just being agnostic and equal weighting the 5 main anomalies was the right one.
Vince, so yes, I do want to jump in. When I spoke to a lot of the market participants, there were 3 caveats that really did stick out. One of them, of course, was time. Now, you don't have the luxury of time because I know that you started the experiment right before the presidential election in 2016, so we're not quite at that 3-year mark. A second one was that different factors are supposed to work in different environments, so you wouldn't necessarily take those 5 and maybe equal weight them. And then another one that was put out there was the idea that you don't necessarily want to buy a factor to beat the market at all times. Maybe you want to buy one to reduce volatility. Maybe you want to buy one to boost income in a way. So I'm just curious what your response to that is as well.
Well, I mean, part of it is true and part of it is a little amusing because in many ways this is exactly the argument that classical active managers give once they stopped outperforming. You know, old school stock pickers say, well, you shouldn't buy us for the performance but for the diversification. So it's quite amusing to see the ETF industry that has for so long dismissed these claims as ridiculous embrace them. So that would be my answer.
Vince, one thing that you point out is that all these different smart beta strategies are correlated to falling yields. And the environment that we've had for the last decade is low interest rates and falling yields. So now that we expect the Federal Reserve to continue raising interest rates and we're in a rising rate environment, how do you expect smart beta strategies to perform going forward?
I think this is a crucial point that you made here. And I think that's a general problem with any sort of quantitative strategy is that for the past 30 years, we have seen falling yields. I mean, from 18% of the Fed funds rate in 1981 to 0% following the Great Financial Crisis. And really, most backtests have to focus on that period. It's very hard to run a backtest before that because you don't have good data. So all the factors that come out of the zoo machine are likely things that look like bonds, like low volatility, high earnings predictability, free cash flow generation, high dividend, high buybacks. So every single factor that you see come out now is a hidden bet on interest rates. And I think one thing that investors need to ask is how likely is it that this will keep outperforming in a rising rate environment? And this is something that quant studies, backward-looking quant studies, cannot answer.
And Vince mentioned the factor zoo, and I think that's something that people kind of jab at a little bit as an interesting phrase, you may call it, but basically the idea that there's a lot of different factors out there. Yes. And there might always be discussions and there might always be new research coming out about a potential new factor. I was just at the Inside Smart Beta conference last week here in New York, and there was an interesting panel, and two of the panelists actually got in a bit of an argument over whether or not momentum is actually a real factor, also discussing liquidity, whether that is a real factor or if it's just another word for size.